Hey guys, I'm Jose Najarro, and today we are going to do another episode of Netflix. We're going to take a look at the financial numbers today, so let's get started. Alright, so like always, first thing we're going to do is use this awesome website known as lazyfa.com, which allows me to see all these awesome numbers, all these financial numbers in easy visual format. So today, like always, starting off with the income statement. So in the income statement, we can see, right, revenue has been and continues to be at a strong uptrend. This quarter being no different, sitting at almost at $5 billion, 4.92 to be exact. Cost of revenue, similar in that uptrend, which is something you would expect, right? As your revenue increases, you would normally see that cost of revenue increase. In the past few quarters, it seems like it's flat-lined. In the past 3 quarters, right now, we can see it sitting at $3 billion. But we took a look in the last episode we did on Netflix, where we look at the earning information they provided. They see that the cost, they're having some cost expenses that they're going to use that they're going to accumulate in the next 2 quarters in the second half of this year opposed to the first half of this year. And maybe that could be one of the reasons we have this low cost of revenue where it's not at an uptrend. Right now, $3 billion of cost of revenue. Gross profit, which is the difference between the two, is sitting again at an uptrend of 1.92. So right, we have that uptrend because revenue is increasing at a faster rate than cost of revenue, and that's why you would have a increase in gross profit, and that's always a good thing. Next, we have operating income, net income, and earnings per diluted shares down here. So next, we're going to take a look at operating income, sitting here at $700 million. So operating income is the revenue minus cost of revenue minus operating expenses. So this is sales, general, administrative. This is any research and development going on here. So after their $5 billion that the company gets to keep $706 million. Then after that, they still have to pay taxes and more and other expenses, and we end up with net income. The net income ends up at $270 million. So out of that $5 million, this company keeps profit of $270 million. So that's definitely a pretty low profit margins right now that this company is having. Earnings per diluted share right now is sitting at 60 cents. Next, one important thing I want to show you guys here is outstanding share. So we can see, right, this here is outstanding shares. A company will sell shares to increase some form of funding. And when they do that, when they sell shares, that means that the amount of shares outstanding out there increases. And we can see in every single quarter, this company increases its outstanding shares by somewhere around 0.2%. And this quarter is no different at 0.15%. So every quarter, this company sells a few of its shares to increase some form of funding. Normally, you don't want to see that, right? Because then more shares out there means that that earnings per share decrease because there's more shares that the earnings need to go around. Next, we're going to take a look at the balance sheet. Here in the balance sheet, I have this awesome thing that I find in Lazy FA, which gives me the asset distribution versus that liability distribution. But before we get there, let's take a look at total assets versus total liabilities. And here we can see total assets are sitting at about $30.1 billion and total liabilities sitting at $24 billion. And here, obviously, total assets are higher than total liabilities, and that's a good thing. And when we subtract the two, that's the shareholder equity. This is what the shareholder is pretty much paying for right after we have their assets minus liabilities. That's the net worth of the company in theory. And that's sitting at about $6 billion. And we can see this uptrend going on the shareholder equity. And that's definitely a good thing. That means this company has been increasing its assets versus its total liabilities. Or it's increasing, they both could be increasing, but total assets are increasing at a faster pace than liabilities. Next, let's go back to the asset distribution, which I showed first. So asset distribution is exactly what it sounds. It shows me where all these assets are. So we can see a huge portion of these assets, almost 80% of the assets are on intangibles. So intangibles are assets that normally I would not consider strong assets because they're usually assets you can't really put a price to them. But it depends on the type of company, and that's why it's good to understand what all these means, because you have to be able to distinguish how to analyze one company from another. like I always talk, intangible assets for a company that sells actual products is not an asset I would want to have. I would not want that company to have high intangible assets. But for a media company, which Netflix is, intangible assets, I believe, are strong, and it's good to see a strong intangible assets. The only thing is the worth of those assets. I don't consider to be a strong value. But right, as a media company, this company has all these different shows that are worth money in some form of another, and that's where we see this intangible assets. Next, we'll have this company has about 20% of cash and cash equivalents sitting at $5 billion. That's definitely a healthy amount of cash and cash equivalents this company has. Property, plants, and equipment sit about 2% of the company's total assets, sitting at almost $500 million. Next, we'll take a look at liability distribution. So liability distribution here, we can see a huge portion of this company's liability distribution is non-current debt. This company, as we can see, and we'll take a look at it later on, this company has a huge non-current debt, and it keeps increasing over time. So non-current debt, right, is just debt that needs to be paid off in the next, not anytime after 12 months. So it can be from now to 100 years from now. So this company has a big $12.6 billion of non-current debt. Next, one good thing is this company definitely has no current debt. That does not mean it has no current liabilities. It does have a $5.29 billion of payables, and payables are current liabilities because this is the amount of money that this company needs to pay off to most likely its licensing, the people that it's licensing the TV shows from. Then we have deferred revenue. Deferred revenue is at $900 million and is 4.75% of the company's total liabilities. So what is deferred revenue? Deferred revenue to me, intangible assets to me are sometimes considered fake assets. Deferred revenue to me are sometimes considered fake liabilities. So deferred revenues are revenue that the company has collected but has not yet delivered the product it was paid for. So right, Netflix has annual subscription base, right? Annual subscription base, but it collects the money at the beginning for the whole 12 months. So this company has a deferred revenue, right? Because right now, let's say we're in July right now. So about half of the year has gone by, but they collected, let's say you started your subscription in January, you paid for the full year in January. So every month they take off some amount of this deferred revenue and put it into assets or put it into their income statement, right? Because right now they still have 6 months worth of products they still need to deliver for me for someone that paid in January. So for them, it is considered liability. It makes sense, but to me, for a company like this, I don't see it going out of business anytime soon. So that deferred revenue is eventually going to make it into the income statement. So next, what else we're going to take a look. Let's see if there's any red flags here. Nothing I really want to take a look at. Next, we're going to take a look at the cash flow statement. Cash flow statement. It used to be one of my least favorite sheets to take a look at, but the more I learn, the more I continue to learn, the more it becomes one of my favorites to take a look at. So here we're going to take a look at net cash flow from operations. So net cash flow from operations, a quick look, it's just the money that is coming in from its everyday use. From Netflix, it's going to be all the money that's coming in from subscription base. So unfortunately, that net cash flow is negative $543 million. So we can see that this company is spending more money to stay up to date in operation than it's collecting money. And we can see it has been like this for a long time. So this company is definitely 100% burning money to stay up in date. So how can it be burning money and not go out of business? Well, that's where we see that net cash flow from financing. So net cash flow from financing, if it's positive, if it's up here in the positive number, it means that this company is collecting some form of money, being loans or selling shares. And this company is doing both. And we can see this quarter, this company collected $2.25 billion of loans or sold shares. And we can see here every 2 quarters, like clockwork, this company for the past 12 quarters or so has been taking out a loan. So here, this quarter, it took out 2.25. 2 quarters ago, it took out 2.05 billion. 2 quarters before that, 1.9. 2 quarters before that 1.6, 2 quarters before that 1.42. And if we take a look at their total debt, we would see, yep, we see it right here, right? So this quarter is $12.59 billion of total debt. And this company, like I said, took out about 2.25. So this should be somewhere about 10.36. So almost that exact money, that exact amount that it took out took out this quarter in loans. That's a much increase. And we can see here, you can see it pretty great in this graph, right? Every 2 quarters, like it makes a step up, step up, step up, step up. So this company is definitely financing its daily operation use by taking out loans. And here we can see exactly how that's broken down. We have debt securities, so this means an actual loan taken out, and this company took out a loan of $2.23 billion. And then it also sold some equity shares. These equity shares were sold at $21 million. So $21 million plus $2.23 billion will give you that $2.25 billion that was positively accounted for in net cash flow from financing. So you can see, right, this company is still increasing its total debt over time, and that's how it's maintaining in business. Luckily, right now we're in a time and place right now where cash is pretty cheap to go. We took a look, and here, right, this is just, I want to show you guys a quick example. In the last episode I did on Netflix, we talked about their cash flow statement, and they raised around $1.2 billion in euros, 1.2 billion euros with a 3.875 low interest, right? That's pretty low. And then $900 million at 5.37%. So both of these are less than 6% interest and 10.5-year senior notes. So the company has plenty of time to pay off this loans, but it's just, I just wanted to show you guys that interest rates, I think anything below 6% is pretty cheap. It is pretty cheap interest rates. Next, we're going to take a look at some metrics. So here, the first thing we're going to take a look at is PE ratio. So PE ratio right now was sitting at about 139.6%. 139.6. That is definitely a pretty high PE ratio, but this was before the drop, and this is based on the trailing 12 months. But let's take a look at Seeking Alpha. I love Seeking Alpha because it gives me these great values on earnings per share estimates. So for 2019, Netflix is expected to make $3.30 and would give the company a current forward PE of 95. For 2020, this company is expected to make $5.63, and at the current price, it will give the company a forward PE of 56. Both to me are pretty high ratios, for such a long time. So that's definitely it is pretty high forward PE ratio. The investors are definitely thinking that this company can make it even higher as future progresses. So the next one we're going to take a look at is debt to equity ratio. So debt to equity ratio is total debt divided by total shareholder equity. And right now it's sitting at about close to 4.0, 3.9. So that means this company has 4 times more debt than it has equity. Is this a good thing? Is this a bad thing? One can't really say, right? Imagine, let's say you have a home, right? You have a home that's worth, that in theory, the home you paid for $500,000, it's worth $500,000, right? This company is worth $500,000. You have an equity of $100,000 of this house, but you still have $400,000 of home mortgage. So that's exactly what's happening here. You have $400,000 of home mortgage, and you have $100 of equity line ready to be used, and that'll give you that full $500,000. Is that a bad thing? Is that a good thing? You tell me. What would you think? What would you think? It depends on everyday use. How strong is that? How high is the interest rate of that mortgage? How much money are you making out of that equity that you have? So all these are things you would have to think about when actually looking at this. Normally, right, in theory, in the best case scenario, you would want this to be less than 1. You will want to have a lot more equity than you have debt. But just because it's the other way around does not mean that it's a bad thing. Free cash flow. So free cash flow, it's after all the financing and everything. This company is still burning cash at a negative $591 million. So that's definitely a scary thing for this company. They did say in the future they are expected to try to increase the cash flow and end up at least break even and eventually a positive. But they did not give an exact date for this. Next, we have current ratio. So current ratio is current assets divided by current liabilities. obviously you want assets to be higher than liabilities. So here you want a ratio over 1, and that has used to be the case, but recently it has not been the case. In the past 2 quarters, this company has dropped down below 1%, so or between the 1 ratio. So what does that mean? That means that this company cannot break off its current assets. It cannot sell off its current assets to pay off its current liabilities. That's okay, right? With the money this company is borrowing, this company will pay off all its current liabilities, but it's eventually I want this thing to go back to 1.0. Gross margins, this company has a gross margin of for about 40%, 38.9% this quarter, and it seems to jump between 40 to 30%, and we can see that here. Profit margins is definitely below 10%. It has a pretty low profit margins at 5.5%, and we can see this jumps all over the place between 3% to about 10%. And right now it's sitting at 5%. Finally, the last thing we're going to take a look at is look at earnings per share compared to net cash flow from operations. So right, this company is telling us that it's past a positive earnings per basic share. But does it really have that in the cash flow? We saw no. In theory, you want earnings per basic share to kind of mirror operating cash flow, right? That means that this company is definitely making money, and we can see it in this cash flow. But with the accounting tricks and everything, we see that this is not the case. This company is showing positive earnings per basic share, but it's doing so with over leveraging and over making money. And is that a bad thing? No, it's not a bad thing, but it's just something we have to keep an eye on. This company has a negative cash flow, and you don't want to see that. Why, right? You don't want to see that fork happening. That's definitely a bad thing. Like I said, you want to see them track, and right now we see that that's not the case at all. I'm taking a look at annual, and then if we take a look at quarterly, it's about the same difference. So it's definitely not a good thing to go. So what do I think about Netflix? So for me, I definitely would not want to invest at the moment on Netflix as an investment type of view and looking for investment. And my main reasons are one, this burning of cash is pretty intense, right? We see other companies burning cash like this, and they get trashed so much, but for some reason, Netflix does not get that heat. Is it a bad thing? No, this company can continue to burn cash. We live in such a cheap market that that's okay. But when I'm looking for investments, that's not something I would like to take a look at. Next, the second reason is right, that forward PE ratio, even for 2020, is still pretty high, sitting at 56 at the current price rate right now. That 30 after that 11% drop. To me, that's still pretty high. For my taste. But if I wanted to get the skin in the game, I would open up with a small position just to have skin in the game. And the final reason why at the moment I wouldn't want to invest was from the last episode, we took a look at the subscribers for Netflix. So Netflix has always missed on subscriber at least once per quarter. So here we can see in 2016, 17, 18, each of these red lines was when it missed subscriber growth, and that's okay. So this quarter it missed. This year it also missed in quarter 2, but the difference is that differential between the two. Back then, look at this gap between them. It is not as big as 5 million compared to 2.7 million. That's a huge miss. And then the scarier thing is for quarter 3, they are expected 7 million worth of 7 million subscribers. So for me, after seeing this big drop and starting to see competitions coming in the next few months, I would rather hold my position if I had one, but I would rather hold now until I see how quarter 3 does. And why would I do that? Because I want to see if quarter 3 is going to deliver as strong as they can. And it would show me what trend this direction is company is going with. As we saw in the last episode, right? This quarter was the first ever, I think in like 8 quarters or at least in the past 8 quarters, where this company actually reported a net loss of subscribers by the end of June 30th compared to the 3 months end. So at the end of June 31st compared to 3 months before that, there was a net loss of subscriber of 126 1,000 subscribers. So that's definitely a number to keep an eye on. So I want that with revenue, with miss and subscribers, when makes me want to have just a hold at the moment. I don't mind missing in on the gains at the moment if it just gives me time to wait and see what happens. Yeah. So that's my thoughts on Netflix. I hope you guys enjoyed the episode. Let me know if there's another stock you guys want me to take a look at. Next, I'm gonna do Microsoft, and I think I might do I might do TSM, which is the semiconductor company in Taiwan, and just to get an overview of where the company sector is headed to. So take care, guys. Make sure to post the comments. Let me know what you guys thought. Take care and see you next time.